Are we ready to get started? It's right at the top
Yep.
of the hour. Cool. Well, welcome everybody for attending our co-buying webinar. This is the first time that we have held an event like this, mostly because it's based on questions that we get from our clients. I am in full festive gear, and I'm Samina, if you don't know me. It's Halloween season, so we're a little batty over here at the Good Deeds group. And if you'd like to meet my team, Elliot, if you'd like to wave, Laura, Brian is also going to be co-hosting, and Tammy is our ops manager here, keeping all the wheels on the bus. And we have Maggie Morgan and Armando as well that you'll be hearing from as we get going in this webinar. So the reasons for this webinar are what we were hearing from our clients. More and more so, we hear people who are wanting to buy homes together. Number one, for affordability. Buying a home by yourself can be pretty expensive. And if you're able to share the cost with someone else, that's great. However, a lot of folks worry about the legalities involved in it, and also what happens if one person wants to exit the agreement at some point in time. What are the logistics, finances, and legalities around that? So we hope to answer some of those questions. So affordability is one aspect, and just communal living, as we're all living longer. The idea of living by ourselves may not be appealing to everybody, so being able to live in a community of some kind or develop that is the reason that we thought it would be helpful to sit down with some of our team members and professionals in our industry to talk about that. So I'm going to hand it off here to Brian. I will be hopping back in to manage the Q&As at the end, but if you have questions as the webinar is going on, I'm sure you're all familiar with this, but at the bottom of your Zoom screen is a Q&A box. You can drop your questions in there, and we will get to them all at the end. So I will hand it over to Brian Williams on our team here, who is going to take it over. Thank you so much.
Hello. So I have been a real estate agent for 5 years, and my real why for being a real estate agent is to help people, and most often that's helping people buy houses. But what I realized 5 years ago was the fall of 2020, and the market was becoming completely insane. An insane seller's market, and so it was very difficult for anybody that I knew to buy a house. And I discovered that pretty quickly, that friends of mine were just not qualified to buy houses, even with a really hardworking and creative lender. And Armando will talk more about that later. Um, but what I have a story I know there are other possibilities for how this can work, besides just the conventional sort of a single person or a married couple buying a house together that we're most familiar with as a buying scenario. Back 5 years before I became a real estate agent, my wife and I met a woman who had a roommate, and she and her roommate had gotten together. They barely knew each other when they became roommates, but they had been roommates for a year or so when we met them, and they had a really successful roommate situation in which they each had joint custody of their one child. They were both single mothers, and they had set up their schedules so that they could have, like, half their time their two kids would be there together, sort of as quasi siblings, and then the other half the time they were together, and they could have parties, and they were both dating people and whatever. So anyway, that was all working really well for them. But what they didn't have was a lot of money, and they just thought to themselves, hey, maybe let's try to figure out if we might be able to buy a house together, because they were envisioning that for the indefinite future, the next 3+ years or whatever, they were probably going to be in this same situation, and it was working really well for them. So they did that with no real legal planning or really thoughts about what might go wrong, which Maggie will talk about later from a legal perspective. But everything worked out really well for them, and this was before the real pandemic boom. So they ended up just going and getting a lender together, and then exploring that, and then finding a house that worked for them, which I think involved 4 bedrooms. I think because each kid needed to have a bedroom, and they wanted to have their own bedrooms, so it was four bedrooms plus an office or something. They found that in Pflugerville, and it was like really the perfect thing for them because they had a kind of office space as well. And so for the next, like, they continued to live the same life, but in a house that they owned together. And so for the next 3 years or so, life went on like that, and then their life circumstances changed because the friend, the roommate, the one we didn't know as well, she her mother was aging, and then her mother really needed a place to live, and they couldn't pay for her to live in a retirement facility or something. So she came to live in the house, and that really changed the dynamic. She lived in they converted the office into a bedroom for her, and pretty quickly, within a few months, it just wasn't going to work anymore. But they had planned that they would probably just end up selling at this point, which is exactly what they did, and they sold at quite a profit at that point, and they were each able to take their money. And our friend went and bought another house, which she then bought right before the pandemic. So she ended up holding that for a few years longer. And what really made that possible was this first house that they had purchased together. So everything worked out really beautifully in this situation. And then my friend subsequently now lives with the man that she married, and she sold that next house. And so we could see how this all worked out really well for her. And there's a lot of luck involved here as well. But it just was always in my head as a story of how you can sort of think outside the box and do something that's not necessarily what society expects you to do, but which can really work out well. So that's what we're now in a situation where it's a lot easier for people to buy than it was, 3 or 4 years ago. But still, because of the facts of our economy or whatever, a lot of people in their 20s and 30s are still struggling to buy, even in this market where it's more of a buyer's market. And so that's why we thought we'd hold this webinar to talk about different possibilities. So, so there are different scenarios of co-buying. The one I talked about here is two friends who are not like romantically related or whatever, just friends who for the indefinite future want to be living together in a house. But we also, I think, as real estate agents, we also all hear friends talk about, oh, wouldn't we let's buy a big piece of land somewhere and all live with our college friends, all get together and build houses on the land. That's another kind of co-buying scenario. That one I absolutely need to have legal discussion about how that's going to work if you start building houses on the property, because it really changes the property significantly. So you should also be talking with a real estate agent about how that might affect resale if things don't work out. You can add things, or you can also end up taking a lot of things away from the property if you sort of start building a structure and don't finish it and everything falls apart or whatever. So you can also there are also kinds of co-buying that are very common that I've experienced. Just like a couple last month, I had an unmarried couple, which is kind of co-buying as well, and then they didn't qualify. They were in their later 20s. They didn't qualify on their own, and so the lender worked with them to try to find one or both of the four parents involved who might be able to help them qualify. And so that kind of co-buying situation can often involve the parents being on the deed as well. So that's something that needs to be explored as to what's going to happen down the road when it's time to sell, or when there's worst case scenario kind of foreclosure situation or something. So we have to think about those things in advance as well.
Thanks for covering those, Brian. Sorry to interrupt. I was going to say that the non-traditional scenarios around buying is such a huge part of why we're doing this as well. That it's just people who are maybe don't fit the conventional mold of a married couple who are buying a home. And
Yes.
yeah,
Yeah.
I think we're just going to see more and more of that as our society and our economics shift in the future. So carry on. Sorry to
Yeah,
interrupt.
that's great. And so, outcomes at the end of it, my friends that I talked about before ended up holding the property for 3 or so years, and then it had appreciated in value, and they decided to sell it jointly to sell it. But you could also have a scenario if it's financially possible several years later, then one person might want to buy the other person's share out, and maybe probably refinance at that point. And or you could potentially, if both people can afford this, you could decide to jointly maintain this property as an investment property and rent it out to other people. And you might, even though you've kind of gone your separate ways and decided to move out of the house, you might continue to buy it and rent it out. And I have an example. I just recently met somebody whose in her divorce decree from her husband, they owned a property, they owned an apartment in New York City, and they have a complicated divorce decree that has a whole, specifies what they're going to do with this property, and they get along well enough to manage this property together. And at some point they may sell it, but at the moment it's working out well for 2 years now, I guess, to be renting it out together. So, I mean, the story of my friends is kind of a best case scenario of how it can work out with basically no planning and just getting lucky. But I would like now to introduce Maggie Morgan, who's a lawyer, to talk about various um, legal considerations in this situation. Maggie runs a title company that is a branch of Chicago Title, and her business is Margaret M Morgan Associates, PLLC. And so Maggie kind of, as I understand it, Maggie, you have two kind of different separate roles. Like one is that you run a title company, and also you're a fee attorney. So you help people with all kinds of different contracts and needs that they have from a legal perspective. And well, I think I think that's enough to
Yeah, no, that's great.
turn it over to
Clear as mud, I'm sure.
you.
Okay, so all super helpful. I think the biggest thing, and I heard a podcast semi recently that discussed um it was this divorce attorney, and he was talking about the importance of planning and the importance of prenuptial agreements a lot of the times, and the idea, and it kind of goes towards all of these things, but the idea is that you should always plan if like something goes wrong, like whatever the scenario is, you should always have legal documents in place that speak to the situation that you're not planning on. If you get married, what does it look like right now when you're liking each other and you're on the same page game plan wise if it doesn't work out? Right now, what does it look like if you and your friend form an LLC and for whatever reason you get in an argument, you move out of state, you get married, whatever it is, what is that situation and how are you planning for it now? I think it's sort of brilliant. And specifically, when you look at the marital situation, you consider how can we objectively and be fair now before the disagreement happens, and let's put it in writing. So I think as you back into this and think about all of the unconventional or conventional ways that you could purchase property and be involved in real estate, how whatever that looks like, how do you plan now? And I think that leaning on, Laura, Sumina, Elliot, everybody on the team, and letting them know essentially, hey, here's what I'm considering. And then they can, as their team of experts and like the whole good deeds group, they can include me or Armando or some other expert in their own right. But I think stepping in one and saying, hey, here's what I'm trying to do, and then letting them point you to the right direction is a good idea. I think most of the situations that you'll be involved in, if it's traditional or not, you should be having some sort of conversation with an attorney. I all the time see LLC agreements come across my desk. So whatever entity, let's say that you decide that you're going to buy a rental property with a friend or start a business or whatever it is, and you have an LLC agreement. You get on the Secretary of State, you decide on a name, I don't know, you get on LegalZoom and you just create this agreement because you think you need to, and then all of a sudden something goes wrong and you don't really know what the agreement says. It felt very fancy at the time, and you have these 35 pages of things where now someone's trying to enforce this language and it's not really something you wanted to agree to. So my biggest piece of advice with any sort of entity formation is that you know what you're signing and you read it and you speak to an attorney about what that even means. You are almost better served not having something in writing if it's a bunch of stuff that you don't even understand versus signing something just to feel more official, if that makes sense. If you end up if you buy anything at all, and I'll lean on Armando for the financing. Cash makes everything simpler, right? You're not the financing piece of it is an additional overlay of requirement. So if you leave that aside, You can divvy up ownership. So if you have multiple people buying a piece of property together, the assumption will be that if you have 4 people, each person owns 25%. You can formalize that with an agreement and say, well, we put more money in, so, I'm the one person, I own 50% or whatever it is. So you can always formalize percentages of ownerships. It's just a matter of getting it in writing and having that agreement up front. There's a lot of pros and cons about different types of ownership interests, and I think the fluffier you get, and by fluffy I mean more complicated, I think you sort of do yourself a disservice unless you're working with an attorney who's advising you. I think that sometimes people feel like formality and complications or things that feel intricate feel more official, but sometimes it does a disservice to you, like I mentioned with the LLC agreement. I think regardless of how you buy, you need a plan. So if you are married or not married, do you have wills in place? Have you talked about who would get your property if one person passed away? If you're not married, especially, because if 2 people, friends, partners, whatever, buy something together and you don't have wills in place, and you don't have any sort of transfer and death deed or right of survivorship agreement put in place, it would literally mean you would pass away and it would go to your heirs at law. So if you had any sort of intention that it would go to the person that you bought the home with, that's not the way that it would default. And I don't think people understand that a lot of the time. Some of the problems that I see that could potentially come up with co-ownerships and entities and how you style it is the way that Texas law works, right? So homestead, people talk all the time about property taxes. The homestead exemption, right, is the legal, calling something your legal primary residence, but as an overlay to that, it's also the rights that you have via Texas law. And the more, like, if you put something in an LLC, you can't buy something and get the property tax. An LLC can't apply for a homestead exemption. So as you try to get more complicated and creative, those are some things that you might consider. If you have, in one of the, I think, examples maybe Brian used or Sumina referenced was involving parents. If you have parents helping buy, that's fine, except the parents probably have a different primary residence. So the 2 people who are buying with the help of the parents, that now means that they can only apply for 50% of the homestead exemption. So some of these things, like as you get creative, trying to come up with a plan so that you understand, yes, we're buying, but are we not saving ourselves money, or are we not able to apply for the homestead exemption? Some of those sort of things I think are incredibly important. I think that having some sort of plan in place before you buy is crucial, and meeting with an attorney, so there are deeds that you can sign that basically says, I'm going to sign this right now, convey the property to whatever person I want. So this could be who you purchase the property with. And it has to be signed and filed while you're living. But if you pass away tomorrow, you circumvent probate and it just goes to this person. So those are some creative ways that I feel like are very time and monetarily impactful and effective, that could really be a service. And that can be, maybe in lieu of doing a will if you don't have the time to immediately do it. But I think it's just important. I think you have to plan for what would take place. Now, selling shares, backing out of agreement, like how you back out of an agreement has to do with a lot of how you got into it. So I think before you get into it, you decide how you're going to back out. And I know that's the least attractive, exciting thing to discuss, but you get burned once and you would never feel that way again, whatever the situation would be. So, again, if there's a loan involved, and I'll lean on Armando for this, but you might have to refinance someone off, or what it would be, whatever the plan would be, without financing in place, removing ownership rights as a deed, just the way that you receive ownership, you would convey it out. Oftentimes agreements will specify, like if you do get this formalized, if you say what would happen if this took place, maybe you give the other person the first right of refusal to buy you out. Maybe it's based on an appraisal that's done at the time of, you get a third party appraiser to dictate what that price would be. Like the things that you can back into reasonably and agree to now can make it later where it's not like you're having to agree later because you agreed now. Those would
Maggie,
be
if
the
I could
biggest.
interrupt there too, I think it's
Mhm.
it almost seems like it'd be easier to get that agreement set up where it's a non-romantic relationship where you're setting this agreement up because there's less emotions when you're doing it with friends possibly than you are with a romantic partner because there's so many, I don't know, so much other layers of emotions in there.
It's tricky, but I think yes, I agree with that. But it's like it's almost even more important when it's a romantic partner because I think it just becomes more complicated with. I mean, what emotions complicated? Possibly no, right? But like the reality of it is the and blame it on someone. Say, oh well, my attorney just really talked about the importance of this, or or I think anything that can be legally protective can be good. You can spin to good customer service or like good vibes essentially. And I've said that for a long time, but I feel like you could say, hey, I hope this works out, and I just want to treat each other fairly if it doesn't. Like, I think that's so respectful. And, or if something happened to me tomorrow, I'd want, like, no, I don't want to discuss that because it makes me feel sad. But, like, ultimately, um, this is something that we could talk about now. But I think you do yourself a disservice by not knowing what your agreements say, not understanding what you're getting into, and ever signing something without formalizing those agreements. It just, it seems inconvenient, but it just becomes a mess later. If you pass away with no will and now you're a person who maybe you wanted to own 100% of the property because you bought it together and had done it. Now it's going to your mom or your brother or your sister, and now it's just an additional overlay. Or you didn't, it seemed awkward to sign this agreement, but now you put in more money and now everybody owns an equal 25% share, even though yours was 50%. It just is what it is. Like there's just planning for these sorts of things. We see them as a group collectively come across our desks all the time, and it just is so important to, yes, be creative, but understand how you can legally protect yourself, and then to do so in a way that's beneficial for everyone. I think that's as broad as I can get without getting out a slide for each of these and boring everyone with what Texas law states. So I will throw it back to you guys.
Great. So now we're going to turn to Armando, who's going to talk about things from a lending perspective. Armando is the founder of Nest and Key Mortgage Company and works as a mortgage loan officer, specializing, as I understand it, in really helping families and first-time home buyers. I've known Armando for just 3 years or so, maybe. We haven't done any transactions, but we've talked on the phone about things. But Elliot, I know on our team has been working with you for 15 years or something, right? Long time.
Been forever.
Yeah. So I'll turn it over to you now to talk about loan issues.
Yeah, thanks so much. So again, my name is Armando Garcia. I am the founder of Nest and Keep Mortgage. I've helped over 1,000, clients either purchase, refinance, or build a home. So I have a ton of experience. As Brian mentioned, at Nest and Key, I think you read that off of our website. That's our mission. So it says we guide growing families and aspiring homeowners through the mortgage process with confidence, clarity, and care. And the reason why I wanted to bring that up is because this webinar is a perfect example of that. We really believe in education. And with education in mind, I like to set the stage or set some facts. And also, Clint, I did see your question, so I am going to address that here at the end. Let's set the stage. So the stage is in the U.S. with the U.S. housing market. Every single decade, going back from even when there was the Great Depression, going back to the Great Recession in the early 2000s, every time you have a down market, meaning values go down, every single decade, if you count just the decade, values have always increased. So as values increase, that means property prices or prices are increasing. And so that's causing an affordability issue on the price side of things for home buyers. On the other side of that, when it comes to financing, I believe the statistic is over 70% of American homeowners have an interest rate that starts with a 2, a 3, or a 4%. The reason why that's such a big issue is because that's what's called the golden handcuffs. We have homeowners who are not interested or feel stuck and not interested in purchasing because their interest rate is so low. They can afford where they currently are today. When interest rates were, 7, almost 8%, the numbers are, the affordability side of it is just doesn't make sense. So we have a lot of buyers that potentially want to move up that are not doing it because of finances, and that's justified. It makes sense. But in addition to that, we have the tail end of millennials, and we also have now Gen Z coming in who are not homeowners. So there's a lot of demand kind of pent up to where one of the most common things that I see that comes across my desk is, or a question I should say is, hey, Armando, when are interest rates going to go down? Right? I have no idea when that's going to happen. But the reason why people are asking that is because of affordability. And they're asking, hey, if the interest rates come down, or they're saying, I should say, I'm just waiting for the interest rates to come down, and once that happens, I'll be ready to purchase. Well, if we know that property values will continue to increase, or historically they've shown that decade over decade, even through the Great Depression, through the Great Recession, every decade they continue to increase. And if we know that we have a ton of buyers sitting on the fence waiting for interest rates to go down, for me, I would assume, and it doesn't mean that this will happen, but I would guesstimate that once interest rates do start to trickle down, and they already have, as of today, we are as low as we were 12 months ago. As they trickle down, we're going to see another wave of home buyers come onto the market. And what that's going to do is just basic economics. Anytime you have, a lot of demand, the prices are going to continue to go up. So I say all of that not to scare anyone, but I say that to kind of set the stage of affordability is going to continue to be an issue moving forward. Not just now. There's a lot of people that say, hey, there's going to be a bubble. Unfortunately, like I said, there's still so many buyers and not enough supply to potentially offset that. So just kind of, setting the stage on kind of where my frame of mind is at and how I'm advising my clients of there is a cost to waiting. And that cost could be higher purchase, lower interest rate, but higher purchase price in the long run. So just something to keep in mind. With that said, and I didn't mean to start that off scary. That kind of sounded scary, but it's kind of the lay of the land, setting the lay of the land.
It's fitting in with our Halloween theme of scary bats and
Yeah, before we came on the call, everyone had a Halloween theme, and I was like, I don't have any bats or anything. So that was my scary.
But you had your witch's brew.
Yeah, my coffee, right? So that's the scary part. But the good part, the positive part, because I am a positive person, is there are creative ways in order to become a homeowner, right? And I think what this webinar was designed to do is to help, spotlight one of those potential routes, which would be co-buying. So with co-buying, I wanted to go over the minimum requirements, right? Sometimes people have concerns that if I'm purchasing with, say, a non-romantic partner or a friend or whoever it might be, someone who is not a family member or a spouse or someone that I'm, going to be engaged to, can I still purchase a property? And the answer is yes. And realistically, there are not, from a lending perspective, there are not a ton of differences. There are some slight differences, but there aren't a ton of differences, for any other situation. And what I mean by that is to qualify for your traditional type of financing. And so I'm talking about your conventional loans, your FHA loans, VA loans. Those are the most common type of loans. Those rules are still going to be very similar. It's going to come down to your credit, your assets, and your income. So I'm going to go over each of those three. First one is credit. So whenever you are hoping to get qualified for a loan, we do a hard credit pull. We do what's called a tri-merge credit report. What that does is we get 3 different scores on each applicant. So let's say it's you and your partner that are looking to purchase this property. We're going to pull a credit report on each of you. It's 3 different scores: Equifax, TransUnion, and Experian. There's going to be 3 different scores. Whatever the middle score of those 3 is going to be the assigned credit score for that applicant. So let's say you have a 660, a 700, and a 740. We would use the 700 as the middle score for that person. However, we look at both applicants, right? And so we would do the same thing for the second applicant. Every loan program has different minimum credit score requirements. There's some that can go as low as 540, which is extremely low. 580. There's different ones at 620. The most common ones will be at around a 620. But to qualify, we go based off of the lower of those 2 scores, the lower of the 2 applicant scores. So if applicant 1, if their middle score is a 700, applicant 2, their middle score is a 600. And we were hoping to qualify for a program that had a 620 credit score, we would be ineligible for that program because of that second applicant. So in that scenario, we would coach up the applicant on how to improve their credit score and set a plan in place to get you there. But that's just something to kind of keep in mind, is depending on the loan program that you're looking at, we would want to meet that minimum credit score for both applicants. Each applicant has to do that. So that's credit. Pretty straightforward. We pull credit, we see where you're at, and then we're either there or we're not. If we're not there, we put the plan in place. The next one's going to be assets. Assets is basically, do we have funds available for the down payment and the closing costs for the purchase? There are some programs out there. We'll talk about the most common one. So for instance, a conventional loan, you could normally do as little as 3% down of whatever the purchase price is. If you are looking at an FHA loan, as an example, that would be 3.5% down. We do have access to some programs, especially for first-time home buyers, where you can technically do a 1% down payment. It is through a down payment assistance program, a grant that you don't have to pay back. But that would be a really interesting program to take a look at for potentially 2 first-time home buyers with limited savings, right? In that scenario, if y'all did 50-50, it's 0.5% for one buyer, 0.5% for another buyer. Makes it super easy to get into a property. But the point being is, with assets, we would want to see that you have the minimum saved up for whatever loan program that we're looking at. And there are thousands of different loan programs. There's not one loan program that is the best program in the entire world. It really just depends on your scenario. In terms of assets, where can these funds come from? So they can normally come from your savings, your checking. We've seen folks, pull from a retirement account. As long as you're purchasing a primary residence, you should be able to withdraw those funds without a tax penalty. You just have to provide proof that you are under contract for a primary residence home. We've seen family gifts. So if you have, one applicant is, maybe has a parent who's willing to gift them funds, we can use those funds. In terms of the percentage of down payment, it does not have to be 50-50 when co-buying. If you have one buyer who has 100% of the funds and you have another buyer who has no cash at all, that's a conversation that you would have with each other on your comfort level if you want to proceed. But from a lending perspective, we would not require it to be 50-50. We would require it to be, do you have enough combined to cover the cash to close, is what it's called, which is, again, the down payment and closing cost. And we can get into some more details if you guys have some more questions on assets. The last one is going to be income. So income is going to be what tells us how much you qualify for. And income is really going to be the one where co-buying really, from my perspective, has a huge benefit, or adds a huge benefit, because by adding additional income, by having a co-applicant with you, you're going to increase your purchase power. And so I'm going to share my screen, and I'm going to show you a scenario of what that looks like, which is basically purchasing on your own and then purchasing with a co-applicant or co-buying. So let's see here. Can y'all see that? Yeah. Okay, cool. All right. So this first scenario, And then for legal purposes, I have to explain this is all just for educational, content or educational purposes. None of this is guaranteed. It's to illustrate what I'm trying to convey to you guys. So in this scenario, we have one buyer. All right, this one buyer, they pay. They earn $60,000 per year. That is their gross income. They have a salary position. So behind the scenes, what lenders are doing, we care about what's called your debt to income ratio. Your debt to income ratio tells us how much you qualify for. And what we're doing is we're seeing how much is all of your debts plus the projected mortgage payment as a percentage of your total monthly gross income. So it'll make a little bit more sense as we go through this. So in this scenario, I'm using a conventional loan, which roughly their ratio is 50% of your gross income. Okay, so if we're making $5,000 a month, 50% of that is $2,500 per month. Let's say that you have an auto loan payment, credit card payments, student loans, whatever it is. I want to keep these numbers as simple as possible. Let's say you have $1,000 per month in minimum payments that appear in your credit report when we pull it. What that means is we're going to have $2,500 to start off with, subtract 1,000, so we have $1,500 left. This is the purchase power. And I do want to note, we do not encourage anyone to push their debt to income ratio to the maximum, right? This is just for illustrative purposes. But you would have $1,500 per month for your mortgage payment. That mortgage payment includes the principal and interest of the loan. It includes the taxes, the homeowner's insurance, and PMI, private mortgage insurance. So in this scenario, with $1,500 a month in around Central Texas, in this scenario, your purchase power would be $180,000, and that's with a 5% down payment. That would give you a monthly total estimated payment of $1,481. So this keeps us under that $1,500 limit, right? $180,000, unfortunately, nowadays is going to be pretty tough to find, something that you would want. It's not impossible, but it's going to be very tough to find something that you would want in Central Texas and Texas in general. So it's pretty tough. So the power of adding a, co-buying is we are adding their additional income to help us qualify. Okay. So what I'm going to show you next is we're going to imagine this person has a best friend who is the exact same scenario. They make the same amount of money, they have the same amount of debts, and we're going to see what this changes. So in this scenario, we now have 120,000, which is 10,000 per month. If we stick to that debt to income ratio maximum of 50%, that means we can use 5,000 per month. We now have $2,000 in liabilities per month because it's 1,000, 1,000. So now we have $3,000, right? It's 5,000 minus 2. We have $3,000 left in purchase power. So we can use this amount for your total mortgage payment. So what this would equate to, again, estimated, would be around a $380,000 purchase price, again, with 5% down. So by adding that second person and adding that income, you have increased your purchase power by $200,000, right? So that's really where the huge advantage of co-buying comes in, is we know that affordability right now is tough. Affordability is the biggest issue to obtain home ownership right now. Purchase prices are high, interest rates are high, people can't afford to purchase a home. But when you take this creative route to acquiring a property, this is when you can kind of open up that affordability.
Armando, I have a question.
Yeah.
So if you have 3 people who want to do this with the same income, debts, etc., would it triple it? Essentially?
It wouldn't triple it, but it would, it's not linear, but it would increase it again significantly, right?
Okay.
So let's say that you had a 3-unit property, right? Or a 4-unit property, and they want to, 3 buyers want to purchase a multi-unit property, purchase it together, and then, have rent out the 4th unit. Yeah, you could do that. It would increase, it would certainly increase. I don't have the numbers in front of me, but I would imagine,
Sure.
600,000, 650, 700,
Sure.
somewhere in there. Yeah.
Which is great when I'm looking at this from the real estate side, because at, a purchase price of 180 is really, really hard to find, but a purchase price of 380 is way more accessible, especially if they're looking at new construction or something else. There's way more availability at that 350 and that price point in Central.
Exactly.
And then, yeah.
Well, also you kind of made me think about it. So like if it were let's say there was, I don't think multi-unit, you guys are the experts on what's out there, but um I would imagine if you had like a 4-unit property and you wanted to rent out that 4th unit, we can also include that rental income for qualifying. So now that really increases your purchase power even higher.
Yeah.
So that would
Even
be
if
another
it's
creative way.
something as simple as a duplex.
Yeah, yeah, a
Yeah.
duplex. Exactly.
Yeah.
Yeah. So all of that would be possible.
Is it different if someone is buying multifamily versus just a single family home?
So there are some no, so there wouldn't be any difference. In fact, it might be a little bit easier purchasing. So the big thing is Maggie kind of touched on it earlier with Homestead. And so from a lending perspective, everything I've kind of discussed is based off of a primary residence purchase, meaning both applicants are purchasing this property as a primary residence.
Got
So
it.
this is what is allowed. If you are purchasing a single family residence and one person does not want to live there, we cannot help. We would
Got
you
it.
it would you, we can only do that if it's a multi-unit property where one person purchases and does not occupy the property.
Thank you.
Yeah. And then that is, I was going to go over the process, but I think I've kind of went over my time already. The process is pretty straightforward in terms of, the next steps. We would do a discovery call to kind of go over these details individually for your scenario. We would go over credit, income, assets, and then from there kind of build the plan out.
Cool, that's great.
Cool. And then Armando, did you want to answer the question that Clint had in our chat?
Yeah.
Let me go back to the question right here.
Yeah, so his question, it's my understanding that lenders do not like an LLC owning a property. It is also my understanding that some lenders have a foreclosure clause in this case. Is that true? Please discuss. Clint's pretty spot on in terms of like your traditional financing options, so your conventional, your FHA. Those options are going to require Fannie Mae, Freddie Mac, and FHA are going to want you to purchase in your individual names, not an LLC. However, it's not impossible to purchase in an LLC and still get financing. So one of the more popular options would be what's called a DSCR loan. With that type of loan, you can purchase in the name of an LLC, and we can assist you with that. The downside with that type of program is it's now more of an investment loan, and so your interest rate will tend to be a little bit higher than it would be if it were just a primary residence purchasing in your own name. So it's not impossible, but it's just a different loan program altogether.
To look at. And then Laura had a question. If one person dies and transfers to heirs or just wants to get out, can one person force the sale of the property? Or maybe it's just another reason to button up with an attorney first. But let's assume you haven't done that. And now, 2 or 3 people bought the property together. One person's passed on or just wants out. What happens?
Yeah, I'm gonna lean on Maggie on that
That's
one
Maggie,
if
yeah.
Maggie's available.
Oh no, I was about to say, are you gonna take a stab at that, Armando?
I want to
Yeah,
take a stab at it. I think I
you're
know
good,
the
you're good.
answer. I have a
Yeah,
pretty good idea, but I'll let you take it.
you can force a sale, but like again, everything costs money. Attorneys cost money, mediators cost money. Going to court to force other heirs to sell essentially costs money. So if you can circumvent that and have some sort of agreement that specifies otherwise, that's ideal. So short answer, yes. Longer answer, yes, but it costs money. And so that just seems to be the least attractive, complicated solution, which is why planning ahead of time is so important. And how complicated that would look would really depend on the circumstances, right? Like, are these family members because someone passed away and now they're feeling emotional and don't want to sell, maybe where this person's been living, or maybe it's less emotional and it's just a matter of there are too many people involved and you can't all agree. I think that could be a thing where a lot of times you'll see maybe 10 children who've inherited this property and 2 don't want to sell. Well, as you know, you need 100% ownership to sell. So having provisions in place that forces agreements ahead of time is super beneficial and helpful.
I do want to add one thing that I forgot to mention that I wanted to mention is from an ownership perspective, and Maggie, correct me if I'm wrong on this, from what I understand, the ownership, there can be a difference, like a split difference, like a 70-30, 60-40. But if you go that route, no matter what, from a lending perspective, it's still 50-50 liability. But Maggie, is that accurate in terms of you can split, or is that not okay in Texas?
Yeah, you can split ownership.
Okay.
Yeah, absolutely. Yeah.
Yeah. So the main takeaway, the reason why I wanted to bring that up and make sure we talked about it is because since you can have like an 80-20 split, like maybe one person is bringing, $10,000 to the table, someone else is bringing $2,000, maybe you want to split the ownership difference because of that. That is allowed, but from a lending perspective, it's still equal responsibility for the loan.
Meaning if one person doesn't pay the mortgage and the mortgage is in default, everyone who's on that loan's credit is going to be affected.
Exactly.
Doesn't matter
Exactly.
what
So
the
it doesn't mean
is.
that you can't have an agreement where like, hey, I pay 1,000 and you pay 200 per month. That's fine. But from, no matter what, 100% of the payment has to get there every month.
The bank doesn't care. They
Yeah,
want the-
exactly.
Yeah.
Yeah.
And splitting liability, like when you think about it logistically, it's not really a thing, right?
Yeah.
You're liable or you're not. So
Right.
Cool. I don't see any other questions in our chat here. If you have any, drop them in the chat. But if we don't see any questions here, we don't want to keep you longer than we have to. We can let everybody
All
go.
right.
Brian, do you want to have any closing statements?
No, I think that was great.
Yeah.
Thank you both so
Thank
much to
you.
our speakers.
Thank you to Armando and Maggie both for all the attendees here. Please reach out to your Good Deeds Group real estate professional for questions about this, because as what my main takeaways from this were plan ahead of time, get everything at least loosely hammered out. If not, you don't need a super formal fancy agreement, but at least have some plan as to what will happen when people leave. And having trusted professionals on the mortgage side, on the attorney side, and on the real estate side, also super important. So we're here for all of that. And we are eager to host more webinars and education events. If there are specific topics that you want us to cover, let any of us know and we can plan for that in the spring. Thank you again all for your time. Thank you, Tammy, for keeping us on track and getting this all organized. Thank you to the Good Deeds Group, Armando and Maggie. Everyone, have a wonderful rest of your week.